Ladies and gentlemen, good day and welcome to the CSB Bank Q4 FY22 Investor Conference Call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital Limited. Thank you, and over to you, sir.
Thank you, Faizan. Good evening, everyone, and welcome to this earnings call. We have with us Mr. Pralay Mondal, MD and CEO, and Mr. B.K. Divakar, CFO from the management team. And I would request Pralay to give his initial remarks, post which we'll open the floor for Q&A. Over to you, sir.
Thank you very much, and welcome everybody to this annual results investor call. We had a very good quarter and a year at CSB, and while Mr. Divakar, our CFO, will take us through and take you through all the detailed numbers, and that's why I'm not getting into too much of numbers. But at the outset, I would like to say that we as a bank have broadly achieved most of the parameters, either on the ratios or on the whether it is NIM, whether it is from a interest income perspective, or even on the non-interest income, if you take the treasury out, which is a non-core kind of income. On the core non-interest income, we have done pretty well. Even on cost side, we have managed so far, but obviously we have a lot of plans in the next few years to grow both our distribution technology and invest majorly into the franchise, because now we are looking at growth. Also, if you look at our capital and some of the other earning per share, I mean, whichever we look at it, I think we have achieved most of the objectives which we wanted to achieve. The only thing which we now need to do is grow the balance sheet and scale the business, and that is what we are focused on. With this, I'd also like to say that globally things are a little different. As we all know, all of you are experts on this, so I'll not spend much time trying to tell you what is going on in the world. But given the inflation scenario and some of the volatilities which is happening, I think clearly there will be focus by which we need to build our liability franchise, and all the banks will be focused on the liability franchise in the next few years. Also, the bond markets, globally what's going on, it has crossed 3%, 3.08 or 3.09, something like that. India is no different, and there are still expectations or that on June 8th RBI policy, there could be another rate hike if that happens. And also with the CRR, the indications are very clear that liquidity will get sucked out, interest rates will rise because the real interest rates has to make sense, and also we have to protect our rupee versus dollar ratios and things like that, right? So to that extent, I think there's a lot which is going in the environment. But the good news is that most of the high frequency indicators are looking good for us, whether it is potential GDP growth, the demand coming back, the GDP growth in terms of whatever the projections are, and hence the credit growth, the government investments coming back. There will be, the LIC IPO so far is looking good. So I think most of the high frequency parameters are looking good. Capex will pick up based on what government has announced in the budget and things like that. So overall growth will come back into the system. And with consolidation happening in the banking system, both in the private and the public sectors, there will be opportunities for banks like us to participate in many parts of the franchise or many parts of the opportunities, whether it is retail, whether it is SME, whether it is mid-market or emerging enterprises group. Whichever way we look at it, there are enough opportunities. We will look at fee income as a important area, whether it is forex, whether it is on the third part liability franchise. We have to grow the granular franchise, while on CASA we grew on an end of period basis 10%, but on average the CASA grew by I think 20 to 23%, which is a good news. That means that we are getting more uniform in our CASA balance, and hence we need to also we are growing our distribution by almost 20% year on year, and most important is going ahead, and we can take some of those things when the questions comes in, that we are looking at significant investment into technology, significant investment into partnerships, and significantly growing the retail and SME franchise and building a franchise model in addition to what we are doing already well, which is gold loans. So our thinking is we'll, as we call it, our strategy SBS 2030, which is sustain, build and scale model. That is, will sustain what you have done well, build the future, which is technology, digital partnerships, leaderships, the products, processes, services. Because if we are a full service bank, we'd rather use that full service bank license and become a in true blue full service bank across length and breadth of the country, and then scale once we have tested our models right, because we also don't want to go overboard on cost, and then so everything will be pilot basis, and once we see that our return on every investment is coming back, then after 12 to 18 months, by that time hopefully our technology will be fully in place, then we scale it up and 1.5% more than 1.5 times more than what the credit growth in the ecosystem is. This is not a guidance, but this is what our ambition is. So that's the way, and it will be, and it should be balanced growth and not just single product or a single franchise kind of a growth. So that's broadly what our thought process is, but we'll take more as we take questions at the end of the conference. With that, thank you very much for participating, and I hand over to our CFO, Mr. Divakara, for taking you through the results. Thank you very much.
Good evening, friends. I will be making a brief presentation about the performance of the bank for the quarter and for the year ended 31st of March 2022. Audited financial results for the quarter and for the year ended 31st March 2022 was taken on record by the Board of Directors at its meeting held today. Performance of the bank improved on several counts during the year. Performance improved under asset quality, earnings, liquidity, and capital funds position. If you can look at the asset quality of the bank today, so net NPA level have gone below 1%, and it remains at 0.68%. And if you can look at the earnings, it has increased manyfold. And liquidity-wise, so our LCR now stands at 154% as against the requirement of 100% by RBI. And capital funds positions has improved substantially. Capital adequacy ratio now stands at 25.90%. Now we are earning profits continuously for the last 3 consecutive years. As you may be aware, bank is following an accelerated loan provisioning policy, and all the toxic assets have been provided at rates far higher than the regulatory prescriptions. During the heightened COVID threat, bank has provided 106 crore for future contingencies. But despite the situation eased a bit, these provisions have not been touched and allowed to continue as a buffer. If this additional provision is reckoned for PCA purposes, our provision coverage ratio would have been almost 100%. Cumulatively, bank is holding additional provisions to the extent of around 214 crores over and above the regulatory requirements. Deferred tax assets created on account of accumulated losses have been completely wiped out. Continue to follow conservative accounting policies on SR. SR level has substantially been brought down. In fact, the appreciation has been ignored, and for all possible impairment we have provided. All these measures have strengthened the balance sheet to a larger extent, and we are moving towards building a strong. Now let me take you through the main highlights of the published results. Total deposits of the bank grew by 6% on year-on-year basis, and CASA ratio stood at 33.66% as on 31st of March 2022, as against 32.19% as on March 2021. Average CASA during the year grew by 22%. Advances grew by 10% on year-on-year basis, to touch a level of 15,815 crore. In Q4 alone, the growth of advances has been at 8%. Average advances grew by 14% during the year. Gold loan portfolio has re-emerged from the negativity of growing at 7% quarter-on-quarter sequentially. Share of gold loans to total advances now reaches its good hold peak levels of almost 40%. It stands at 39.2% now. Net interest income has crossed 1,000 crore mark for the first time in the history of the bank. By posting a robust growth of 23%, the net interest income stood during the financial year 2021 at rupees 1,153 crore. NIM improved from 4.81% to 5.27% on year-on-year basis, or by 46 bps. Average earning assets grew by 12% on year-on-year basis. Thus, net interest income growth has been powered by both volume as well as spread improvements. Cost of deposits during the year improved from 5.07% to 4.31%, or by 76 basis points. Yield on advances improved from 10.97% to 11.21%, or 24 bps. Yield on investments reduced from 6.81% to 5.93%, or 88 bps. As a conscious strategy, bank had not replenished the HTM gap in the initial months of the quarter, expecting yields to harden further, and preferred investment in short duration paper, which had impacted the yield a bit. Non-interest income. GSEC market has been unidirectional in financial year 2022, given the global scenario of increasing yields and heightened inflation, even before the uncertainties of a prolonged war emerged. This gave little room for treasury profit booking, which was a key contributor to the kitty during last financial year. Benchmark 10-year yield increased from 6.18% to 6.84%, or by 66 bps. Thus, while we could book 102 crore of treasury profits in financial year 2021, when the yields were falling, the corresponding figure for financial year 2022 is only 12 crore. M duration for AFS portfolio stands at 0.65. Non-interest income excluding treasury profits grew from 201 crore to 235 crore, or by 17%, powered by growth in commission income from rupees 50 crore to 72 crore, or by 44%. Total staff cost decreased year-on-year basis from 496 crore to rupees 482 crore, or by 3% on account of lower AS15 provisions. Staff expenses, excluding AS15 provisions, increased from 259 crore to rupees 322 crore, as total employees increased from 4,180 to 4,662. Other operating expenses has increased from 233 crore to rupees 305 crore year-on-year basis, or by 31%. Number of branches increased from 512 to 603, contributing hike in other operating expenses. Operating profit grew from 516 crore to rupees 614 crore, or by 19%, on the back of improved net interest income and reduced staff cost. Cost to income ratio improved from 56.2% in financial year 22 from 58.6% in financial year 2021. Net profit has increased from 218 crore to rupees 459 crore on year-on-year basis, or by 110%. There has been rupees 10 crore net reversal in NPA provisions in financial year 2022, powered by NPA recoveries on both gold and non-gold portfolio, as against additional provision debit of 107 crore in financial year 2021. Despite this reversal, provisioning coverage ratio has improved from 84.9% to 89.7%. ROA has increased from 0.99% to 1.90% on year-on-year basis, and ROE from 21.2% to 12.5% to 21.2%. Book value per share increased from rupees 117 to 144, or by 23%, and EPS from 12.6 to 26.6, or by 111%. Asset quality. This was a prominent quarter in terms of NPA recovery, where we could contain both gold as well as non-gold NPAs. Out of the gross NPA of 289.51 crore, rupees 28 crore is gold loan NPA with a higher recoverability. Gross NPA decreased by rupees 104 crore from 393.49 crore as on 31st of March 2021 to rupees 289.51 crores as on 31st of March 2022. The gross NPA percentage that was at 2.68% as on 31st of March 2021 improved by 87 bps to 1.81% as on 31st of March 2022. NPA in gold loans decreased from rupees 45.39 crore to rupees 28.81 crore on year-on-year basis. Net NPA percentage decreased from 1.17% in March 2021 to 0.68% in March 2022, or by 49 bps. In absolute terms, net NPA reduced by rupees 62 crores to rupees 107.11 crores. Our leverage ratio stands at 9.2%. Liquidity ratio has improved to 154%. Capital adequacy ratio is at 25.89%, which is well above the regulatory requirement of 11.5% and previous year's reading of 21.37%. As I said earlier, leverage ratio has been improved to 9.12%. It is up from 8.11%, well above the regulatory minimum of 3.5%. Thus, bank has done well under all critical business and profitability parameters. While consolidating our performance, we have strengthened our balance sheet to a larger extent. Adequate provisions have been made both for known and unknown losses. Now, we are happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The first question is from the line of Digant Haria from GreenEdge Wealth. Please go ahead.
So congratulations firstly on a great performance for the whole year. So my question is to Mr. Pralay. So you just did a passing mention that this year would be a little more about liabilities for everyone, including yourself. So what I wanted to check was that, see, we give the lowest savings rate interest, I see it's right from 2% to 3.5%. Our deposit rates are also, maybe at par with the largest banks. So how do we, if we have to grow our balance sheet this year by say 20-25%, how do we plan this whole liability strategy? If you can just give some more color on this, that till now the liquidity was easy, so despite lower rates, we were getting deposits. But what happens in the next 2 years?
See, I will answer it in two parts. One is, if liquidity is there, it's not easy to get deposits because everybody is competing and there are various instruments. But we have a very high loyal base of customers in Kerala in our branches, and we have seen we have almost 95% plus kind of a renewal rate with our customers. So I have analyzed the portfolio and I've seen that and these have happened through cycles, irrespective of interest rate cycles. So which means there must be something good we are doing in terms of retaining the loyalty of these customers in all interest cycles. So we obviously will not take things for granted. We continue to engage with these customers and continue to do the woodwork. That's one part. Second part is that, but yes, that will not help us in growing the balance sheet of what we are doing. So we have to build on top of that. So we are investing more into branches. Secondly, we are investing into a sales structure in liability by which we'll get more customers. And when I say for us, liability is different to some other banks like HDFC, Axis, etc., because they already have a large customer base. We have to build up a large customer base, not only for liability. Liability is just not about deposits. It's about a franchise. And on that franchise, as we now launch our retail assets, other payments and other products, fees, etc., we will be able to cross-sell to those customers. So for that, we need a very large acquisition strategy to get to the bank. And that not necessarily is to do with rates, because some of these will be savings accounts, some of these will be, small FDs and things like that. Some of these will be, solution oriented. We'll start looking at corporate salary and those kind of businesses gradually in the smaller corporates, etc. So, and as we expand our markets into the north and west and north rather, in that hierarchy, we will need these products and channels to add more customers to the bank. So that's number one, and that's number two, which will help us in growing the customer franchise and hence the liability, the granular liability, which will remain with us. The third point is we are not looking at rates as the primary way, because when you give rates in cycles, on margins which we don't want. B is we don't want rate shoppers coming to the bank at the end of the day. We want to build a very long-term franchise. So from that perspective, we'll build solutions. So we are planning to create teams which will focus on task, which will focus on solution-oriented businesses. On the SME side, we already were telling the SME side that your job is not just getting asset business. You have to be self-funded. Start with 20-30%, and then we'll see how do we do it. So I think we have to look at that every part of the bank is looking at the whole customers. For example, if you are having an SME customer, somebody, you can get his personal accounts, you can get his family accounts, you can get liabilities. So those are the kind of focus which we want to start. The third thing is that branches, especially the metro and urban branches, they have to focus a larger part, because a good liability customer is eventually a good fee and asset customer as well, and hence they have to focus on liability. And in a cycle, if you have to continue to grow at a rate at which we want to grow, and we definitely want to grow faster than the market, and significantly faster than the market, if that is so, we definitely need to build a liability franchise. I understand your question that there is a cycle which is picking up, but at the end of the day, also a lot of these banks have big, large back books, and not everybody can give rates, throw rates on the liability side of the day. And a lot of these large banks have grown liability franchise without throwing rates. So we don't have to throw rates. I have worked in many organizations where you can do without giving rates, but building a solution. And we have people in our team who knows how to acquire customers and what is the strategy which we can put it. And last strategy on liability, not liability, but a customer franchise we'll build digital and partnerships. We are going to invest significantly on technology, significantly on partnerships, and significantly on solutions. So based on this architecture which we'll build, we will get a lot more customers, and when customers come, they will come along with the liability as a float, or whether it is on the current account side or on the savings side, etc. Because eventually, if you have a EMI to pay, and that's the reason we have tied up with, for example, an HDFC for home loans or for credit cards with somebody else. Even if you don't have those products also at this stage, eventually we are building everything. We don't want a situation where our customers are going and shopping around for some products to somebody else. So all of this put together is a liability strategy. Liability is just not giving rates and getting deposits, because they will not last, and they will be a negative impact on our cost of funds. So that's broadly the strategy. So it's an execution strategy and not throwing rates.
Right. So thank you so much for this detailed response. So my second question is on the operating cost, that we already saw some operating leverage coming through this year. Now that you say that you are going to do a lot of partnerships, build a lot of different capabilities around the bank, do we still have this operating leverage, the lever of operating leverage in the next 1 or 2 years? And if yes, if you can just quantify what's the dream cost to income or target cost to income that we have for our bank?
See, one is ratios and numbers. One is I will give you more strategic perspective and how to quantify that. Nobody knows better than Mr. Devakar and Mr. Anthony are sitting here. So from a strategic perspective, I'll tell you what. Any ratio is a numerator and a denominator, right? So, and sometimes you have to upfront certain investments to get the numerator. So we will not shy away from investments. So any cost which you look at it, I want to divide cost into cost and investments. And every investment will have a payback period. And then I look at costs separately. A lot of costs, actually the operating leverage will come down because of the investments we'll make, because a lot of these operations will do straight through. A lot of these branches which you're seeing, a lot of operations have in the branches we're actually, as we're talking, we're taking documentation out of the branches, we'll take operations out of the branches, we'll do straight through. A lot of products we're launching which are straight through on the SME and the other side. We have already launched some of them. So we want to make branch either they are focusing on gold loans which are heavily operating model on the branch, which is a brick and mortar structure, and we'll continue to do that in some of the and most of the branches, especially in the rural markets, in the semi-urban markets, and non-metro branches. At the same time, we would like to see that the front of the branch, how to ensure we leverage a lot more for sales and service. So all of these together, because as you know that when you build a customer franchise, there is a front-loaded cost out there, and typically a branch breaks even, a large metro branch breaks even little more than a year, a gold loan branch breaks even less than a year. So customers breaks even in a year's time. So once you have this continuous growth on customers, you will have a little bit of operating cost, and we will get the operating leverage by taking a lot of straight-through processes into the ecosystem. Finally, once this productivity starts kicking in, which will take year and a half, and by that time our technology strategy will be in place, you will see the real operating leverage for us will start coming somewhere around 2025 onwards. Okay. Till then, it's an investment phase, and then I'm not seeing too much of a improvement on the cost-to-income ratio, frankly. But there, if you look at it till then, cost, you please see which of the costs are going into operations cost and which of the costs which are getting into investments. And as I said before, we'll put a lot of investments into partnerships, manpower, resources, and technology.
Right. Perfect, sir. So thank you so much. I'll come back in the queue. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Prashil Shah from Capgrow Capital. Please go ahead.
Yeah, just a follow-up on the previous question. So you mentioned that the focus should be sort of on how much is going in the investment, the cost, how much of the cost is going in investment and operations. So currently, what would be the proportion, and what would it be, let's say, in 2024, 2025?
So this is from my perspective, it's a difficult question to answer. Maybe Mr. Devakar can try. But I don't think we have looked at it this way, because a lot of these investments, what are the investments? Investments is technology. And again, technology investments is broken into 2 parts. One is operating cost and one is capex, right? Which gets depreciated over a period of time. Second part of the investment is sales structure and sales and acquisition. And third part of the investment will be partnerships. These are the 3 investments which will go in. I think we have, because we were, trying to sort of consolidate the balance sheet and ensure we deliver what we delivered this quarter and this year, we were a little focused on getting our act right in our bank and getting where we have reached, which is very, very well appreciated by everybody. From here on, the next phase will be growth phase, and in that growth phase, these are the investments which are going to get into it, and hence this will all be incremental investments, if you ask me, whether it's a sales structure, whether it's partnerships, whether it is technology. What would be so these are all incremental. Where the cost will come down is basically the operating leverage which you'll get from the branches, because if you add more products and more services to the branches, you automatically get operating leverage. And very difficult to give a calculation where we have not done all this in our life cycle yet. because we have not got those products yet. Once you get those products, then only you know how much. And those products alone will not help because if you don't get those customers into the branches. So all of this, in my experience, comes together at one stage, which will take 12 to 18 months. So currently, if you ask me, mostly 40% of our business is gold loans, right? It's very easy. I mean, those ratios, Mr. Devagara can give you that. What is our OPEX cost? I mean, I think overall our operating cost to income will be around 3 point something, right? What is it? Yeah. 3.5 or something like that. So those ratios are there. But the point I'm making is that we have to invest these to build a growth-oriented franchise. And whatever investments has to be made, we'll make them, and they will have a payback period anytime between 12 to 18 months.
Okay, and my next question is on the ROE. So we have seen excess of 20% in the last 3 quarters. It was mainly sort of driven by recoveries and the negative credit costs essentially. So going forward, maybe in 23 and even in 24, how would we sustain an ROE of this magnitude? Even maybe not 20%, but at least something like 15 or 16%.
Yeah, we have been able to register ROE of 20% plus during last 3 to 4 quarters. So credit cost has become negative only in this quarter. But if you see per se as such during last 3 quarters, so we have made provisions. The credit cost was there. Despite that, we have been able to show ROA in excess of 20%. So we may be able to maintain this. So the profitability projections, what we have in mind, and the business parameters, what we have envisaged for the current year, I don't think so we will be having any difficulty in reaching these figures.
So also if I can add, if you get into the growth momentum, okay, which should happen because there will be opportunity in the market, etc. See, if you look at it, our capital is very high, right, at this point of time. So as we start consuming more and more capital, getting into the growth mode, and obviously, it will automatically, on one side, it will give you slightly higher ROE. So that I think that what you are asking and what will happen here in terms of growth, both will balance out, and we should be able to deliver the ROE.
Okay, I'll get back in with you. Thank you.
Thank you. The next question is from the line of Nirmal Bari from Samiksha Capital. Please go ahead.
Yeah, sir. Congrats on the very good set of numbers. Thank you for giving me the opportunity. My first question is on the current market environment, based on what the RBI has said in terms of reducing liquidity as well as increasing interest rates. Typically, in the last few calls, what we have been discussing is that there's been excessive competition, because of which we were sort of not able to grow in the SME, MSME side. So with the current environment now, how are we placed to capture this growth opportunity? Second is, if you could talk a bit in terms of technology, what are we doing? We had a new head of technology, CTO, I guess, a couple of quarters back. So, and what all steps are we taking that? These are the 2 questions.
Sure. So on the first question, let me put it this way, that what is happening in the ecosystem is good news for us, because we want to do prudent business, and in a way it is good that we didn't grow that much in a very low interest rate regime where the cost of funds and all these were so low that the kind of businesses which has been done, some of them may be term loans, some of them may be working capital, we don't know, but not necessarily whatever, even a variable rates, the real interest rate that will go into the market may be slightly higher than the real hike which happens on the regulatory front. So these are linked to certain rates, right? So to that extent, at least we'll not be in that uncertainty. We don't have those challenges today. So we did prudent business based on the whatever cost of funds we had, and we don't have those cost of carry of those assets with us right now. So that's advantage number 1. Advantage number 2 is because when such liquidity is there in the market, almost everybody goes and does businesses. I'm not talking about only the large banks. There are a lot of people, including NBFCs, everybody. A lot of people does business, which becomes very difficult to compete when we wanted to run a prudent balance sheet. But I think scenario will change now, and there will be a lot. I have seen this cycles twice before. And there will be rational pricing that will happen in the market, and this is the time when we want to go to the market and wet our feet on the SME side and some of the other businesses. So we see SME as a major opportunity for us in the next 2 to 3 years, because retail will take time to build. Till then, SME, mid-market, these are the segments which will grow and which will do well. And today and now onwards, we are willing to participate in that market because we believe that rates will be a lot more rational than what used to be before. So that's on that front. Coming to the technology side, there is lots happening. In fact, I am personally involved significantly in our technology initiatives which are doing it. So we are dividing into 2 parts. One is running the bank and one is building the bank. So on running the bank, as we grow our balance sheet and our customer expectations grows and new products, new services, the LOS, a lot of things which you are given in some of the other banks, which we are implementing now because we didn't have those products and services. So we will be at par on some of these products and services. Because if you don't have those kind of pathway, you can't run proper retail assets or payments or some. Building the bank for future, obviously we have to, what Rajesh is working on, he is the new CTO. So what he's working on is, evaluating how our core system is and what are the options we have there. B is what is the surround system which you need to build. And third is how the plug and play system which will work on the outer layer and how these 3 will get integrated along with the workflow system which you're taking on the LOS, whether it is corporate LOS, whether it is the retail LOS, whether it is LMS, all of these we are investing right now. As we're talking, it is happening. And we are also investing significantly on the cybersecurity front because that is something which we need to be very clear if you want to build the digital bank a lot more aggressively. And then the other part which you're doing is we are saying that if this is running the bank today and this is building the future today, we can't be remaining without doing things. So what we'll do is we'll do a lot of plug and play kind of a digital solutions which will be disposable models, let's say. So next 2 years we'll use it and throw it, and by that time our future is built. So we cannot wait, because if somebody tells me somebody will give me a system after 3 years, I cannot wait for that. So we will use, for example, I'll give you an example if you want. For example, if you look at a lead management system, or if you look at easy connectivity with a partnership model, etc. So how do you do all that? And one of the reasons we are also looking at it is because even from a regulatory perspective, the thought process is changing a little bit and saying that do we want to do it this way? Do we need to look at cloud as an option, etc. So we see a lot of technology changes happening in the next 3 to 4 years. Cost of obsolescence is very high. So we are also evaluating all that and seeing that is it better to go full hog and invest into all the systems at this stage, or some we do based on our current volumes and then throw it and build it based on whether by that time the cloud model is prevalent, and then your whole operation becomes very flexible and faster. So those are the various things which you are working on, but we are primarily looking at running the bank and building the bank.
Mr. Bari, does that answer your question?
Yeah,
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Mona Khaitan from Dolat Capital. Please go ahead.
Yeah, hi, good evening. So my first question is, if I look at the numbers from a sequential basis, quarter on quarter, your NII growth was flattish versus loan or interest earning assets growing at 7 to 8%, and yet margins were largely stable Q on Q. So what has helped NIM despite the flattish NII growth?
No, if you can look at this Q3 results with that of Q4, so marginally it has come down. It is mainly because of two reasons. The first one is with regard to migration of NPAs. That has happened mostly in Q4 as compared to Q3. And maximum recoveries have been affected in Q3, especially with regard to gold loans. Gold loan recoveries was done to a maximum extent during Q3. That is why if you can look at it, this net profit was higher in Q3. That was now most of the gold loan NPAs have been recovered. So from a peak level of around 288 crores, so today it has come down to 28 crores. So it has come down almost 1/10 of what it was in June 2022. So September itself we have been able to recover, but between September and December we have recovered maximum. So that is why that so whenever as and when it is recovered, what will happen is that even the uncharged interest that was reversed when it was being declared as NPA, that again that interest income will be available for us. That is the interest income was more in Q3 as compared to Q4. But now most of these NPAs have been recovered. So that is why that to that extent the interest income has come down in Q4 as compared to Q3.
Okay. So now that gold portfolio has largely stabilized with GNPAs at 0.5, 0.6% or thereabouts, where would you expect a steady state margins to settle at for CSB Bank?
No, from SME, if you can look at our SME portfolio, so that is giving an average yield in excess of 10%. Similarly, gold loans, it continues to give a yield of 11 plus.
Mm-hmm.
And corporate advances, so is giving a yield of around 8.5 to 9%. These are all stable sources of income with fixed earnings. That is why our net interest margin, if you can look at it, it has improved to 5.27% as compared to 4.81% during March 2021. So margins have improved mainly because of all these factors. Yield on advances has improved. Cost of deposits has been brought down.
So Mona, to give you a little forward-looking answer, Mona, let me give you a qualitative aspect to it. So let's look at it, cost of deposits, cost of funds, whichever way you look at it, and let's look at yield separately. So cost of deposits obviously will go up, right? I mean that's no rocket science in it. At the same time, we have both a MCLR link book as well as a repo rate link book, and repo rate will immediately get impacted as soon as we announce. As soon as we 1st of July, right? It will get impacted positively, and MCLR will, depending on what is the duration of that, based on that it will get impacted. So to that extent, at the same time, we have to look ahead and say we cannot look at short term and say that being our deposit business for the next 3 months, 6 months, right? You have to look at it slightly because this interest rates is going to be here for real for the next 2-3 years if the country does well. So given that perspective, we have to raise deposits and hence our cost of funds will go up. But at the same time, we still have some long-term deposits which is there in the system, which will get renewed either at the elevated rate where it is coming today, or at a slightly higher rate than if it was booked slightly in the short term in the last 1 or 2 years. So overall cost of deposits is bound to go up a little bit. At the same time, we will be able to pass on some of that depending on how the competition is playing on that side. So to that extent, I think at the margin, there will be not too much of a difference, and that could be the story almost for all the banks. For us, it could be a little different because we'll also change the mix of the business a little bit. Our gold loan mix, I see continuing to do what it is today because we had a very muted growth last year, and this year we want to take the growth up, and that will help us in our yields to some extent. At the same time, we will look at even better quality portfolio on the SME side. We want to participate in the real SME business, and hence, if we have to sacrifice some yields on the SME or wholesale, we'll do that because we have the gold which will grow and it will at least hold the mix what it is today around 39-40%. And hence, on the margin, I think if we want to build the quality of the book even better for the long run and with a cost of funds little bit of increase, Whether we'll be able to hold back the NIM where we are today, we don't know. Okay, but we will not sacrifice growth to hold the NIM of 5.72 or 5.3 or whatever it is. Okay, so growth is paramount. And for that, and quality growth is most important, because we don't want a growth which is toxic growth. We will have a quality growth, and for that, if a little bit of a NIM sacrifice is required, we'll look at it as and when it comes. But growth will be there, quality of deposit franchise will grow, and we will gradually change the mix of the business. But this year, there will be no change in the gold loan mix at all. And hence, that will hold the yield to a great extent.
Okay. But then could it continue to be the over 5% that we have seen in the last couple of quarters at least, or could it moderate below 5%?
At least for the next at least for the next 2 quarters, I don't see a risk. Beyond that, we have to figure it out.
Sure. And any timelines on the rollout of retail products and color on the products will help?
Yeah. So on the retail products, actually, if you ask me, all retail products can be rolled out together once we have the A, customer franchise, B, the technology to roll it out, right? So we are working with our technology partners on LOS, LMS, and some of these. Because the risk of retail business is if you do it branch-centric or if you do it without technology, etc., there is either a very a niche strategy, or it will come back to bite you. So we are working very hard on the technology framework. Policies, processes, all are ready. So maybe we are a little late into this, and you get a little impression that we have been talking about it, but there's a lot of work going on the technology side, and once it happens, then things will happen very fast. So, and retail, as you know, cannot be built in one day. We have to build up the liability franchise in parallel in terms of customer base. So all of it will happen together. Parallelly, we'll do through partnerships, but what we'll not do is, also we'll do co-lending as a business, which you can look at the underlying assets as retail. We'll look at securitization again on underlying. We have done securitization primarily on the microfinance and gold so far, but this year I have been discussing with the team. We'll do securitization on, because I think businesses like CB and some of these things will come back, CE, because if the infrastructure, there will be a lot of investments from the government. I think CVC, commercial equipments and commercial vehicles, healthcare, all these businesses will start picking up. Some of these we will participate ourselves, so we are building a team. Some of these will participate through either through securitization or through partners or through online or through co-lending. We'll figure that out. So all of these are different modules of building up a retail business. Something will be directly on our book, something could be through securitization route, something could be through co-lending route. We'll figure that out. But whichever way we do it, we will gradually build up a long-term retail highway for us.
And it is possible that these may not come up within FY23 and get extended to FY24, or in terms of...
There is no problem at all. We don't need to rush into it, because my experience is in retail, if you rush, you make mistakes. Okay, that does not mean that we are not working on any of this. We'll do what is prudent for us, and we don't need all this for growth this year. Okay, we have our clear strategy on how we'll grow our portfolio. And whatever we have planned for our growth, we'll do that irrespective retail contributes in a big way or not. But retail will contribute in a big way next FY.
Got it. And on the recovery from written off accounts, I understand it's adjusted against provisions in your case. Is that a fair assumption?
No, this year we have done maximum recoveries under written off accounts. That is why the credit cost is negative. So it has been netted off from the provisions to be made. In fact, we have made a reversal of 10 crores during the current year. So,
sure, got it. And just
maximum recoveries have been done. So bad debts recovered is 78.7, whereas the provisions to be made for NPS is only 68.9 crores. So we have made a net reversal of 9.8 crores during the current year.
Got it. And just finally on the investment in technology that you spoke about, if I look at your OPEX to assets, which is a more stable indicator rather than the cost to income, it was at 3.2% for FY22. So could one assume a similar kind of ratio going forward, or could it rise given your, technological investment plan?
It may marginally go up, because, but these are investments. These are not costs for me, as I said before. Okay, because we will not shy away from investing into technology. That's very clear. Because whenever we look at things, we don't look at quarter to quarter anymore. We want to look at the next 3 years, 5 years, or 10 years. So to that extent, these investments are nothing. And a lot of technology cost will be capex cost, right? So it does not hit you in the same year in a big way. I don't see too much of OpEx coming there.
Only depreciation to the extent.
Only depreciation, yeah. Only depreciation will come. So to that extent, it gets distributed over a period of time. But yes, we will invest a lot more in technology this year and next 2 years at least.
Sure, thank you. That was useful, and all the best.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Prashil Shah from Capco Capital. Please go ahead.
Hello.
Yes, sir. Please go ahead with your question.
Yeah, actually, I wanted to continue on what I was talking about earlier. So, see, what I'm trying to say is this year we had an ROA of 1.9% in FY22, right? This was aided by negative credit costs for most part of the year. So a steady state credit cost for us would be around 1%, right? So if it is 1%, so from next year onwards, how do we plan on maintaining an ROA of 2% for FY23? And especially because you just said that OPEX to average assets will be going above 3.2%.
So, see, there is not one, like banking business is not a monoline business. There are many tools to leverage. So one of the tools we leverage is non-interest income. Okay. So this year, the worst has happened on the treasury side, right? I mean, how much worse can happen this year? So not from our perspective. I'm talking about the cycle and from the market perspective. And Mr. Divakar can explain that how good our portfolio and how safe our portfolio on the treasury side is in a rising interest rate cycle as well. So given that perspective, and in spite of the fact that our treasury income was very low compared to what it was the previous year, we could still manage our net interest income at a reasonable level. You can see the momentum, non-interest income at a reasonable level. This is happening because of core non-interest rate growth, which are third-party business, which are forex businesses, which are liability and commission-oriented businesses. So these things, as we grow the balance sheet, and if your focus is on growth, these things will multiply, right? So I think some amount of non-interest income will start growing. There will be some pressure on NIM in the second half of the year, I'm sure, for all the banks, not only for us. And as you said that, but I think our slippages should be under control. I don't see slippages as a problem because a big problem last year we had multiple problems. If you ask me, in spite of that fact, we have done well. The entire gold loan, 75%, 90%, that problem was a huge problem. I think the team has done a tremendous job in executing it, and we are today deciding that we had a reversal and all that. If you look at the year-on-year, it doesn't show. But if you look at quarter-on-quarter, the gold slippages and all that was significant, and it has been controlled. So this year we can have a growth. Last year we couldn't grow on the gold loan. And tonnage, we did well, but because of the 90 and 75%, we had a problem. So there are certain positives which are there. Also, growth will come, right? Not everything is in ratios. It's also growth once we get back. And then in absolute terms, we'll start doing well. So overall, and for a moment, if I say that if we grow better and even if my ROA comes down by 3 basis points, 4 basis points, 5 basis points, how does it matter? We are growing a franchise which is a much better long-term compounding growth story. So that's the way we look at it. I don't want to be so myopic in terms of saying that if we are at 1.9, something at 1.9. It can be higher, it can be lower. We'll figure that out.
But even otherwise, we were expecting this interest rate to happen. Keeping this in mind, so almost 2,000 crores of our amount has been invested in short-term assets in treasury. So essentially in treasury bills, so which is at present giving a yield of around 3.5%. Now the 10-year GSEC is giving us a yield of almost 7.40%. If this gets replenished, so with that, so clear about the 4% clear visibility is there to grow. So almost 2,000 crores, and in the HTM category itself, we have got an headroom of almost 350 to 400 crores investments we can make. So without bothering about this, the investment depreciation likely to come if the rate of interest is likely to go further. So to that extent, we are protected. So we have invested in short-term assets, essentially in treasury bills. That gets invested in some other alternate opportunities wherein we will be getting a higher rate of interest. That's more or less so will give us the required income to sustain this level of 1.90% to 2%.
Okay, and I mean I agree the balance sheet is doing really well in terms of asset quality. The quality is solid. I agree with you. So on the growth part, are you willing to put a number to it? How much do you think you will be growing in the next 2 to 3 years?
So I already told that I said that if the system growth at X percentage, we'll grow faster than that. How much faster? Maybe in the next 2-3 quarters we'll tell you more confidently, but we'll definitely grow faster than the system.
Okay, thank you so much.
And if you ask me the question over the next 3 years, I can tell you that we'll grow faster than the system by close to 1.5 times.
Oh,
next
okay.
3 years, not right now. Okay.
Yeah, that's okay. Thank you.
Thank you. Ladies and gentlemen, this was the last question. I would now like to hand the conference over to the management for closing comments.
Thank you, and thank you everybody for participating. We are very excited with the prospect of having I don't want to look at it as the next 1 year. As I said, we want to look at 3 years, 5 years, and 10 years kind of a horizon. And we are looking at that long term when we look at any strategic decisions. And there are a lot of strategic decisions we're taking in the bank today. We are building the bank for the future. We are building growth, a mindset, and we are building product services as a full service bank, as I said in the beginning. So don't want to look at quarter to quarter. At least we want to look at year to year as we build the franchise. So thank you for being on the call, and we look forward to your support, and I'm sure that will not disappoint you. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Axis Capital Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.